I think we're at the dawn of now thinking about these longer term transactions that capture the drift in climate normals over time. And that's really going to help a company set up for long-term sustainability, for physical risk. How do you think about your infrastructure in the future in a world where it's wetter, drier, hotter, colder, windier, less windy, right? So you couldn't, in my view, have started with climate. We had this sort of, by definition, start with weather. And that's really where the acute issues were as far as earnings volatility. But I think where we're heading in the long term is more toward managing climate as well. So I think you'll see that expressed as a pair of risks or a pair of hedges, right? Where somebody will say, look, I own to buy my weather risk for this year or this year and next year, but I want to buy a drift product for the next 10.
Welcome to Smarter Markets, a weekly podcast featuring the icons and entrepreneurs of technology, commodities, and finance, ranting on the inadequacies of our systems and riffing on ideas for how to solve them. Together, we examine the questions: are we facing a crisis of information or a crisis of trust? And will building smarter markets be the antidote? This episode is brought to you in part by Abax Exchange, bringing better price discovery and risk management tools to navigate today's commodities markets through centrally cleared, physically deliverable futures contracts in energy, environmental, battery materials, and precious metals markets. Smarter Markets are here.
Welcome back to Weathering Decarbonization on Smarter Markets. I'm Dave Greely, Chief Economist at Abax Technologies. Our guest today is Martin Malinow, CEO of Parameter Climate. We'll be discussing his work in building weather and climate risk transfer markets from the days of Enron to today. And we'll be discussing where these markets are now, where they're going, and what we need to be doing next to get them there. Hello, Marty. Welcome to Smarter Markets.
Hey, how are you?
I'm doing well, and it's great to have you here. We always enjoy talking with the people who are building new markets, and you've been a pioneer in building climate markets for over 2 decades now. You got your start at Enron in the very early days of the weather markets. So I wanted to ask you, what was that like, and what were the weather markets like back then?
Well, I would tell you that the weather markets fit around one large dinner table at that point, which was pretty interesting. But I'll take you back a little bit just to put that in context. Is I spent the first 10 years of my career as a fixed income derivatives trader, and sort of in a road to Damascus moment saw across the Bloomberg ticker that the weather market in 1998 had hit $1 billion. And I had my epiphany and I was like, this is what I'm going to do, right? It's ground floor, it's sell side, it's derivatives. I know how to do all this stuff. I kind of understood the motivations for the buyers and I understood the motivations for the sellers. And I was like, hey, this is for me. And I sent off a couple of letters swearing that I'd never leave Los Angeles, where I was living. And a month later, I was living in Houston, where I swore I'd never live, working for Enron. And what I found was in the early days, since it was a brand new market, right, there was no sort of infrastructure. The people had a kind of, by definition, all come from somewhere else, that the early participants in the market, like myself, had all come from different capital markets. They came from the commodities market. They came from one guy came from the junk bond market. I came from the fixed income derivatives market. So we had sort of an amalgam of talent and experiences that really didn't directly pertain to what we were about to do. And I think that helped us in a lot of ways because people were bringing experiences on how to build markets and what were the things that we needed, like clear index points and other types of market infrastructure that was going to get it going. But it was definitely a bit of the Wild West, and people were trying to figure out, okay, well, we did the first trade, that's great. And then trades 2 through 100 happened in about 7 minutes. And we were starting to think, okay, well, how do we apply this to other risks beyond the initial sponsors of the transactions, which were the energy markets? And I think there was a certain hubris, given how much of the global economy was impacted by weather, that people were saying such things as, this market's going to be bigger than interest rate derivatives or interest rate swaps or FX trading. And, I don't need the naysayer sort of like think back and sort of make me out to be the person that was maybe a little skeptical and maybe right about it. That's not really who I am. But, I was just thinking at the time, well, those markets have very standardized risk, right? Like if you're doing business in Japan and you want to repatriate your yen into dollars, like that's pretty standardized, right? if you're a utility in Paducah, Kentucky, a standardized US temperature product probably doesn't fit you. It's a very customized risk. So nonetheless, we were all very excited and we thought it was going to become huge fast. And I think, as some of my colleagues have very perfectly put it, we thought the market was going to be revolutionary and it turned out to be evolutionary.
And when you think of the markets back then and fitting around a table, what were the weather products that were being traded? Was it mainly temperature, heating degree day, cooling degree day, things tied a little bit to the natural gas markets, or was it beyond that at the time?
Mainly heating and cooling degree days early on. We started to encounter certain things. I mean, it's funny, like you realize now that people, like things you just kind of know when you come into the market, but then somebody had to think that through. So, for example, like, hey, we're going to trade cooling degree days, and that's great in the United States. And then the market very quickly spread to Europe. And people are like, well, I want to do cooling degree days. And then when you think about, okay, well, I can convert 65F to 18C. And then when you look at temperatures, especially 28 years ago, there weren't a lot of days where average temperature was greater than 18C. So it's like, wow, what's the April cooling degree days trading at 4? And so people are like, all right, well, we need to do that different. So why don't we just do cumulative average temperature so we can have a higher index with, where we don't really get to zero very often. And it's not bounded by zero. So that's an example of kind of like some of the early stuff. It was mainly HDDs and CDDs. Then we quickly adopted cumulative average temperature. And then it kind of went from there. People are like, all right, well, let's think about cases where people would need sort of cutoffs on the daily temperature. So I care about the degrees above a certain point, like 65, but let's say it's more extreme, days where Tmax is greater than 95 degrees. In Houston, for example, count 1, else count 0, or count those degree days. So the market's natural creative juices sort of took off pretty quickly. And within the temperature complex, we saw a lot of growth and creativity, and that sort of spilled over into other products as the market started speaking to other verticals and companies in those verticals who had risks that maybe were not temperature based.
And now, all these years later, you're CEO of Parameter Climate, and where you're building what you call climate risk transfer markets. So, it certainly is broadened out. What is climate risk transfer and why does it matter?
Well, look, the market is mainly sort of supporting weather risk transfer. And so there's a couple of definitions, or at least my view of those definitions. Other people may have a slightly different view on those. But the first one is climate is what you expect and weather is what you get, right? So by and large, the majority of the transactions are under 1 year in tenor, kind of like the reinsurance market. You get to reprice those or re-rate those every year. So you get the experience from the previous year. And if it was sort of a loss impacted transaction last year, whether you had the loss or somebody else had the loss, there seems to be a bias toward recency. So people will try to take that into account. So it's a dynamic market. And you'll hear it also put as like climate is a non-stationary risk. So although we've mainly been handling the impact or hedging the impact of weather volatility on sort of less than a year basis, what you need to model and set before you can measure and model and price that weather volatility is you need to understand the forward point, which is kind of what you expect. It's climate. And you need to understand the volatility around that. And you've modeled that by definition from a long time series and adjusted it and done all the things you'll do. And that's sort of climate in the second moment or standard deviation or volatility. So you are effectively modeling the climate. But now when you think about climate risk transfer, you're going beyond 1 year. So what you're thinking about now is the drift in what you expect. So if you expected 1,000 millimeters of rainfall as a grower, which was going to get you an expected yield of X, and it's getting drier in the climate, well, you're worried about that expectation of 1,000 millimeters drifting down over the years to 900 millimeters as sort of your jumping off point. So kind of what's the 10-year average or the 20-year average going to be 10 years from now? And when you think about it that way, now you're thinking about climate risk. And that is sort of that's where we want to head. We're never going to stop managing weather volatility because I think it's super important to earnings and sort of the shorter term volatility around earnings that companies have to manage. But I think we're at the dawn of now thinking about these longer term transactions that capture the drift in climate normals over time. And that's really going to help a company set up for long-term sustainability, for physical risk. How do you think about your infrastructure in the future in a world where it's wetter, drier, hotter, colder, windier, less windy, right? So you couldn't, in my view, have started with climate. We had to sort of, by definition, start with weather. And that's really where the acute issues were as far as earnings volatility. But I think where we're heading in the long term is more toward managing climate as well. So I think you'll see that expressed as a pair of risks or a pair of hedges, right? Where somebody will say, look, I want to buy my climate, I want to buy my weather risk for this year or this year and next year, but I want to buy a drift product for the next 10.
It sounds like there's a lot of thought and a lot of work that goes into doing such a long-term product, right? Like it's much more than trading weather farther out the curve. It sounds like. Do you have specialized, has it even gotten to the point where there are climate risk products, or is it at an earlier stage of the market for those?
It's super early stage. I mean, there's products that are intended to manage climate risk, and then there's sort of longer tenor weather products. So let's say, somebody wants to buy protection not only for this winter, but for the two after that. So it's sort of a 3-by-1, right? They're buying 3 years of 1 year or one season protection, right? So we've seen in wind, people have done 10-by-1s. Why have they done that? They haven't done it to manage the drift risk of the wind expectation. They've done it to get financing, right? So it's made wind projects more bankable because you could go back to your financiers and say, look, I've managed the tails of this, of my project's profitability, and therefore I want a better or a higher loan to value. I want more leverage, and I want a lower coupon rate on my note and a lower debt service reserve fund. Therefore, I get better terms. And that's really been the motivating factor. So we haven't really seen anyone say, okay, I'm really worried about the rainfall drifting lower as a grower or a cooperative, and I need to buy protection against that because my world's going to look very different in the 10 years from now with 900 millimeters of rain as the expectation than 1,000 today. And I'll deal with the volatility at that point. But that's a much different risk. It's a horse of a different color in some ways because your models need to extend out. You need to either have some view of the future statistically or some view with a forecast, which is not very accurate, to be honest with you, beyond kind of like 15 days. So certainly 10 years forecasting is not something that I would hang my hat on. Or you need to start to think about, I'm going to start to create a set of stress cases and say, well, what if the slope of the drift is X versus Y? What if the change in the volatility is A versus B? And I can now start to create some scenario testing that's going to put boundaries around my risk and allow me to price that risk with greater confidence. Other ways to do that, you can have some resets in there where you'd recalculate the strike based on sort of experience. But at the end of the day, if you're hedging drift, the buyer's like, look, I don't want you to reset my strikes. I care about what happens if the expected rainfall, as measured by the trailing 10-year average, is less than 900 millimeters at this spot 10 years from now, right? And if that's the case, then I need to get paid.
And when you describe the 10-by-1 wind and making a wind project more bankable, sounds like the pretty straightforward application of the commodity playbook of if you're a commodity producer, you typically want to hedge out your production out the curve a little bit, and then that de-risks the projects, makes it bankable so you can get lending, so you can actually make the investment. When you look at who's in the weather risk, climate risk market now, does it tend to be those producers who are looking to invest in renewables? Or can you give us a sense of who has the exposures that they want to be transferring right now?
Yeah, I mean, again, it's mostly weather. And I would say that the main vertical, the main corporate sponsors of these transactions as the protection buyers are still within the energy space. And, given renewable energy, I think you can bifurcate that vertical into sort of traditional gas and power, so more of the utility type player, and then the renewable type player. But there's a real big overlap now because a lot of the utilities own their own fleet of renewables. So they have an asset base already in wind, solar, some in hydro, or they're an off-taker of those assets, right? So if you're a big utility and you need to buy power and then a wind farm comes to you who needs to sell power because they're a producer and they're like, look, I want to do a power price agreement, PPA, for the next 10 years. you as the utility buyer, you need electricity anyway, but you're not buying firm electricity, you're buying intermittent electricity. So you have to price for that intermittency, and that price shows up as a discount to firm. It shows up as a haircut, right? So, and that kind of gets to the crux of the matter in that weather risk or climate risk or any kind of risk, the uncertainty that it creates has financial impacts, and people will put their thumb on the scale, whether too hard or too light, to try to account for that. And they'll wind up, that translates into dollars lost for somebody, or a trade not done, or an asset not built. So really what we see the value here, where we see the value of weather beyond just hedging volatility, is firming up the certainty around risks like, how much intermittency am I expecting? How do I price that intermittency? What happens, by the way, if the wind doesn't show up and prices go up and I have to replace that power in the spot market when 10 of my friends are doing the exact same thing and we're all like falling all over ourselves, and we drive electricity prices from $100 to $2,000, right? And now we're losing on every megawatt hour that we serve, or we're covering our contracts on the other side. So that's kind of what's going on in utilities, right? There's sort of the financing angle, which has really not been explored too much yet. Most of it is the integration angle between renewables and sort of utilities, where they're looking, all right, well, I've got this intermittency risk here. How do I manage it in a manner where I can be reliable to my ultimate customer, which is the ratepayer? But when you look outside of energy, like, what other verticals are we seeing interest in? Well, one is certainly agriculture, right? There's a difference, though, in that what we're seeing in agriculture typically is a complement, or in some ways a replacement product for traditional yield insurance, which may or may not exist in certain places. So if it doesn't exist, well, hey, that's great. It's sort of a native product, and people need it. But like in the United States, where you have a pretty established, highly subsidized crop insurance market, it's a little harder for an unsubsidized weather product to sort of edge its way in, throw some elbows, and attract business, because you're competing with the government who's, giving 60 cents plus per dollar of subsidies. So agriculture is a risk where, for the most part, it's going to look a lot like the traditional product if it exists. And if it doesn't, well, hey, that's great. Energy, there really isn't another product, right? It's not like, for years and years and years, energy companies were buying volumetric protection of weather from Lloyd's, and then suddenly a bunch of smart guys started trading derivatives, right? That risk was always there, the volumetric risk, and weather is a volumetric risk. So the only way that it could really be handled is with a parametric product, and hence the dawn of the modern weather derivatives market in the late 1990s. So now that's a very good question to ask as we start prospecting in other verticals. Like, is my product going to be novel, or is my product going to be a lookalike? And if an insurance company or reinsurance company or insurance-linked securities fund takes that risk on, are they effectively aggregating more risk, or are they diversifying, right? With weather for energy, it's mainly a diversification. With weather for crop, it's an aggregation. You're going to have to make some choices about how much traditional you do versus how much parametric you do. So as you sort of logically run that out, now you're like, all right, well, what about construction? Novel, doesn't exist. All of the risk is retained, weather delay risk in construction projects. Somebody has it, and it's the old, I don't want it, you take it. No, I don't want it, you take it. And you have a game of ping pong because everybody's trying to hit the ball back over the net, and the owner doesn't want it, and the contractor doesn't want it, and the subs don't want it. So there's a great use case for a product here, which is novel. And then you can play that out, and I won't go into all the verticals here, but that's sort of the way, in our view, that you would want to prospect and you would want to product test.
One of the things I find very interesting when we talk about weather markets is the large role that the insurers and the reinsurers play, because I think it's much larger than you see in other commodity markets, right? So where it tends to be more dominated by the banks and the institutional investors, and it's more of a looked at as a derivative product as opposed to an insurance product, though they're both ultimately doing the same thing in terms of transferring the risk. How do you think about like who the players are that are willing to take on this weather risk in the markets you work with? And how do you think about the role of the insurance companies versus, say, the institutional investors or the banks and their derivatives desks in enabling that risk transfer?
Yeah, it's a great question. I mean, look, I would preface that question by saying the weather market right now is kind of this big. And for those of you who can't see me, I'm holding a volleyball maybe in my hands, right? when in fact it should be this big and I'm holding something like a gigantic beach ball in my hand. And the question is, okay, well, why is that the case? Well, the market is certainly underbought. Like, it's a complex product and it's a complex market to navigate. And it's sort of a fragmented market when you talk about capacity, right? You're talking about institutional investors, reinsurers, insurers, insurance-linked securities funds. Like, where do I find those people? How do I find those people? That's not easy, right? Now you go to the other side and you're asking about the capacity market. And you're like, all right, well, the traditional players, at least to date, have been reinsurers, not primary carriers, right? You haven't seen the Travelers and the Allstates and sort of, the people like that, Zurich in the market. I mean, it's mainly been very, very sophisticated reinsurance companies who are playing a primary role. They're playing the role of insurer, right? By being a counterparty on derivatives trade. So Swiss Re, Munich Re, other companies that you'll know, but those are the sort of big two. And when you think about that, well, that market is also small. Maybe it's a tennis ball and it should be the size of a beach ball. And it's like, okay, well, why isn't it bigger? And how do we make it bigger? And I think part of it is the issue that a lot of the sponsors right now, at least the large majority of the trades, come from energy companies who use derivatives. Why do they use derivatives? Well, it's nothing like financial weapons of mass destruction or trying to get one over on anybody. It's just that, well, for decades, they managed their price risk on exchanges, or they did over-the-counter derivatives. And when they started managing their volumetric risk, it was like, well, I'll just do that as derivatives too. Same people that were buying price derivatives are like, well, that's easy. There's an ISDA. Why don't we just adopt the ISDA to handle weather trades? But you'll see a lot of the insurers and reinsurers don't want to sell derivatives. It's not, again, like it's a dirty word because they use them in their asset management. They may manage their FX risk or interest rate risk using derivatives, but by and large, insurers and reinsurers want to have risky liabilities and safe assets. So if you were taking what is in effect a risky liability and you're trying to fit it into the earnings model and reporting model of an insurer or a reinsurer, that derivative is not going to sit in the big line item of premium and claims, right? It's not going to sit in that underwriting income area of the income statement. It's going to be in investments. So suddenly, when interest rates haven't moved over the quarter and the S&P 500's flat and everybody's kind of doing what they expect to do. And if you were to have a bad quarter in your weather derivatives book because it was too hot, too cold, too wet, too dry, too windy, not windy, whatever, you would report that volatility in your investments. And no CFO of a reinsurance company wants to look different than anybody else. They want to beat their peers in their combined ratio by like a point or two or more, but let's say a point or two is great. And by and large, they all hold the same risk. Well, now you're the only person holding weather derivatives risk. And you now come up and say, well, my combined ratio on my insurance business was 2 points better, but my investments were 5 points worse. Therefore, I'm net down 3. And everybody's like, well, what the hell do you have in there? It's a lengthy explanation, and I apologize for that, but it is the biggest reason that insurers and reinsurers who want this type of risk, because it doesn't correlate to other lines of business they have, whether it's natural disaster risk or casualty or other things, they don't want it in derivative form. So you have derivative buyers and reinsurance sellers, and then you have to now start thinking about the dark arts of transformation. How do I transform a reinsurance capacity contract, reinsurance treaty, or a facultative reinsurance deal into a derivative? And there's technology, if you will, to do that in places like Bermuda and other sophisticated insurance jurisdictions. And it is called transformation or transformers. But you are, in effect, transforming contract types so the reinsurer can preserve their reinsurance or insurance accounting while the buyer gets what they want in terms of an ISDA contract. So there's your biggest issue. And that's one of the things we've been working on at Parameter. We have 2 vehicles in Bermuda that do that transformation so we can allow our buyers, protection buyers, to have access to a much broader capacity market, because we're solving that last mile problem for not only the insurers, but also the institutional investors who don't have a rating, but now they'll be happy to collateralize 100% of the deal. So if a European utility is buying a 10 million euro low wind protection, that collateralized player is happy to put the 10 million euros into a trust account in Bermuda. But the credit manager of the industrial buyer, that, let's say that European utility, looks at that and they're like, their hair starts on fire because it was like, okay, well, nobody's ever offered to do that before. Like, what do you mean? Like, there's a place with palm trees. That sort of scares me. And there's going to be a trust account. All right. And you're going to put collateral in that trust account. And like, what am I missing? So there's a few things here that need to sort of complete that last mile. You know, you need the channel tunnel here. It's short, but it's going to do a lot to connect the continents, if you will, of sort of the capacity market with the protection buyer market. And like, that's something we've seen for a long time. And we've been very lucky to work at big reinsurance companies that could provide every kind of contract type and large capacity. But, you know, we saw that as a problem to solve in starting Parameter. And that is exactly what we're doing with our Bermuda vehicles. And we think there's a big future to that.
That's fascinating because it's very common sense that every insurance or reinsurance company needs to be showing the strength of the asset side of their balance sheet, as that's their business, right? And it's probably regulated as well. And so if you're extending insurance or taking risk and it's flowing through on the asset side, which should probably be full of very safe things, but it's part of your insurance company, you're not going to be able to do that. So it's fascinating. Kind of, it's like almost makes me think of all the adapters we have for plugging things in. How do you wire these markets up so they're connecting in the right way? And I wanted to ask you, that's a great example. Are there any other things that you saw as missing in these markets? Because you've built a number of companies, you've been deeply involved. So what have you seen otherwise that's missing in terms of taking these markets from tennis ball size to beach ball size?
Look, before I answer that, I always seem to have a preface for you, but I think it's important. You said something really precise, and it's in language that we use a lot. So I do want to sort of shout that out, is that you use the concept of an adapter. And it's funny, I had that in one of my slides. I sort of went and pulled a picture off of Google of like, you one plug in, many plugs out, right? And it was like, hey, and you know what? You can plug your USB in here if you're collateralized, or you can plug your plug in here if you're rated. But that really is a great description, in my view, and a great visual for what we're trying to do and what the market needs. It's not only about Parameter per se, but it's about the broader market. If you're going to connect a very deep capacity market, a potentially very deep capacity market, and really allow the buyer's market across these multiple verticals to scale, well, you need those adapters, right? For the reasons we just discussed on accounting and stuff like that. So there is a business to be had, and it's certainly going to grease the skids to the extent that a buyer can just plug into a single counterparty, because they don't want to KYC and set up 37,000 different counterparties out there when they may not trade with a lot of them or ever maybe, but they want to have them. So to the extent that somebody like ourselves can say, well, okay, we talk to 50 people, but you only need one ISDA, right? You're going to set up one single ISDA and KYC one counterparty, which is Parameter Capital. And now out of the back of that, we'll handle the wholesale plugging and playing for you. Well, that adapting is what's going to allow that tennis ball to get to the beach ball, right? So that is one part of it, as you said, and your question that I want to address now are, what are the other missing pieces? So when we started to work on raising money and we put together our first decks, we had sort of a visual of 6 cards. Here's the problem. And if you want to flip the card over, here's the solution. And you need to flip these cards to basically do things like providing that bridge or that adapter that you mentioned as one of them. And there's a couple of things that the market lacks. It's got a couple of practices that are very intuitive to understand as to the origins of that sort of practice, but it's not going to allow the market to scale. So the biggest issues that we identified and the issues that we're trying to solve with Parameter is a different kind of company than we've ever worked at before, and maybe different kind of company that's ever existed in the space, is like, not only is the market lacking sort of broader capacity like this, it's lacking analytics, right? Like, you look at other markets and there's CTRMs or ETRMs in the energy space, right? So people have, knows the brand names, but there's 5 or 6 really big players that have sophisticated derivatives trading models that are fantastic and allow somebody to just sit down and get started and take their crack at it, right? And build their business in commodity risk management, either on the buy side or the sell side. Right. In the insurance-linked securities market, which is about 25 years old, there are 2 main modeling firms that provide, called CAT models, if you will. But that market, the insurance-linked securities market, which covers about $120 billion of capital now, in my view, wouldn't be that size or developed to this extent if there weren't vendor models that help these managers prove to their LPs, their investors, that in fact, they didn't just build an Excel model, that there is a widely accepted, regulator accepted, credit rating agency accepted model that they can model and measure and cost out the Florida hurricane risk or the Cal quake risk or the European windstorm risk. And then they can put a premium on that is multiples of that and gives them an expected margin or alpha, right? So without that, that market wouldn't be that size, the ILS market. So when we looked at the weather market, we're like, okay, again, maybe back then, a couple of years ago, ping pong ball. And it's like, well, one of the things that's missing is that everybody is sort of sending Excel spreadsheets to each other. And if you're lucky as a buyer, you get an Excel spreadsheet with 7 lines, London, Heathrow, cumulative average temperature, call option, 2,500 strike, here's the notional, here's whatever. And by the way, here's the premium. And then it says, please wire 2 million pounds of premium to this bank account for the benefit of, and here's, by the way, a time series graph of the index on Excel, which has the same blue and orange colors that default out. And here's the historical paths. God bless you. Welcome to the market. And we'll talk to you whether there's a claim. And so that in and of itself doesn't really inspire the sort of confidence where people are going to be putting down tens of millions of dollars, either in spending premium or in hundreds of millions of dollars, let's say, of capacity, right? So besides having a bit of a Tower of Babel in that people are like, well, this is priced well to the 10-year. And then somebody's like, well, it's priced badly to the 20-year. And somebody's like, it's priced great to the linear to trended. Like everybody is speaking their own language. There's not enough information. There's not a consistency of information. And there's certainly, you're dealing in an environment in Excel, which is wonderful by and large, but it's fraught with the ability to have errors, right? You pull down your cell, it doesn't have an absolute reference. You got cockamamie stuff. Somebody's got the wrong index they bought. They're unhappy. Ugh, not good. So with all that as preamble, there was a huge opportunity to create a market accepted analytics platform, which is what we endeavored to do in creating Climate Delta. And we've got we've got a fairly large subscriber base, and we use it for our own business. And we see Climate Delta as the digital rails that are connecting or that will connect a very fragmented club, right? The club's the size of a ping pong ball. The potential market's the size of multiple beach balls. So you need to have these connection points. You need to be able to measure and meter a dollar of risk from when it is structured and executed and bought as it flows through the various time steps and the various company steps and through various hands. And you need to be able to market every day, every month, especially if you're, let's say, a fund. You need to have a net asset value every month that you can let investors in and out of the fund on. So if you can't mark your positions, you can't invest in those positions. So you need something that is going to do all of that. And again, I think the analogy for us is it really is, it's a set of digital rails that connects every player in the market. And now you or anybody else can run their own rail car on top of that and move risk around. And again, you know how far you've gone and you know how much energy it's taking you to get there, and you know kind of your payout at the other side and what you owe or what you're expected to receive. And so like that was a big gap in the market. I'll mention one more before I take a breath. The other one is syndication and intermediation, right? Like the markets were very winner take all, right? Because the sizes couldn't be big because there weren't a lot of capacity providers, and the balance sheets that were involved. If there was a $20 or $30 million trade, a large reinsurer could say, I'll take the whole thing. So unlike reinsurance, where you have great syndication and now every CFO has a commonality of risks, so they make sure that they're not going to look too different from their peers. They're just going to beat them a little bit on risk selection, much like a long-only equity manager, right? You're all managing to the same index. Well, everybody's got different risks. So, reinsurer one just takes this $30 million deal, and let's say it's for heat in Dallas, and then it's really hot, and they cop a $30 million loss, and like, I don't like that risk anymore. I don't want it next year. Well, now you're the buyer. You don't have this panel of 12 people or 10 people or 5 people on the risk that you can go back to, and they're going to give you more of a stable sort of renewal. You just lost your counterparty, or he's charging you some ridiculous price to come back on the risk. You're like, what? Now I got to go out looking again. So that winner take all mentality needed syndication, and syndication needed intermediation. And the insurance brokers were never very interested or savvy at the sort of the weather derivatives market. So there was nobody there to really help out. And the commodity brokers, who are doing a good job right now by and large, there's only a couple of them, were more transactional, right? They're trading spot or they're trading futures or forwards. And so a lot of them, and I'm not saying this disparagingly, don't even know what the big figure is. It's like, 90.91, yours at 90, where you left, 89.90. It's like, then you're like, here, by the way, your new thing is you're going to do structured multi-peril weather derivatives in 3 different cities, covering this, this, and this with an aggregate deductible of this and an aggregate limit of that. And it's just a completely different language, culture, experience base. So the intermediaries that should have been there weren't there. And the ones that were there weren't really geared to do that kind of business. Therefore, they were happy if somebody said, yeah, I'll just take the deal. And it's like, yeah, there you go. And so, we've had this sort of headwind to growth based on the fact that not only did we not have a commonality or a sort of a consistent analytical foundation, but we had no syndication because we had no intermediation. And then the last thing is we had no advisory. Like complex products, somebody wants to pick up the phone. You're like, hey, I need help structuring a product. Well, who's on the other side? The insurance brokers typically do that and they weren't involved. So now your counterparty is advising you on structuring the deal. Do you really want your future counterparty to be the one that structured your deal? And if it doesn't work out, do you want to go back to your risk management committee and say, we didn't get paid? Well, who structured it? Well, the guy I did the trade with. So there were some things to fix or improve on. And I see it as sort of low hanging for people who know what they're doing. And for us, it's like, well, we've been part of the problem for the first probably 25 years. Let's try to fix it. And as we go off into retirement one day, we can at least put our hand on our hearts and say, hey, we expiated ourselves for all our sins. And we've tried to help the market grow and become what it truly can be, which is a very large beach ball.
Well, I think you've given one of the more vivid descriptions of what people mean by a market in its cowboy days or Wild West days, with the emailing Excel spreadsheets around with some charts of, I don't want to say dubious, but non-standardized origin and doing $20 million deals. But it sounds like there's been a lot of evolution since then. As we've talked about, you've got the adapters that plug in the right way. So getting to the financial products that start to connect the market, getting to more standardization, it sounds like, both in terms of how you measure risks, how you create products, getting more intermediaries so you can spread that risk around a little bit more, create a more liquid market. So I just wanted to ask you, like, maybe if we use the baseball metaphor of what inning do you see these markets in right now? And then where do you see them going? And more importantly, before you retire, what do we need to be doing to get them where you see them going so that they can get to that beach ball size?
Well, to the extent it doesn't happen by the time I retire, I have a decent retirement gig of sort of working for the market, whether that's for the market, the industry association or something. But I'd like to do. It's a market that I have a lot of passion for, and I know a lot of the people in it. And there is this sort of wave of, well, we'll just say people sort of over 50 that have been in it for a long time that are starting to age out and want to do different things. And so like the market is going to sort of lose a lot of experience at some point. And so, we need to create institutional memory in the market, right? Where that is not having to be relearned by the 20s and 30s and 40-year-olds that are going to pick up the torch and carry it forward and light the darkness of the future. So I think a fully functional market has more liquidity for warehousing, big, hard to sort of trade risks, things they have a lot of complexity. It's a structured product. And you have these warehouses like insurance and reinsurance companies that are not naturally traders. So they're warehousers. And like we said, we need more syndication there. But increasingly, if we get institutional investors involved and we give them we solve their last mile problem, which we talked about, you can have a lot more trading oriented investors or players in the market that might say, well, okay, I can take on that large structured deal. And I think I understand how to trade around it, over time, over the next year or 2 years or 6 months or whatever that is. And maybe it's a quanto where it has a bit of temperature and a bit of gas in the settlement calculation, right? Well, how do I think about the gas delta in terms of temperature, the temperature delta in terms of gas, right? And so there are going to be other people that want to manage that risk more actively because they may not like the returns of warehousing the risk, and they like the returns of actually actively managing it like they do a nonlinear options book. It's like, hey, I could hold a bunch of gas options in my book, but that doesn't seem like the smartest career move, or I can kind of manage that because there's liquidity in the gas market every day. Well, how do you do that? Well, exchanges, right? And so exchanges like AVAX, CME, whoever else in the future are going to serve a really big part of the market. And look, the CME has been involved in the market for a long time and they've done a good job to date, but the market needs more exchanges. It needs exchanges that host different types of products. It needs exchanges with vision where they think more, well, perhaps they conceptualize their product less as the contract that's listed, and more as the ability to clear a group or a class of products where you have the ability to customize in a market that really needs customization, right? Like everybody's risk is sort of unique in some way. But at the same time, there are indices like the ones that ABEX listed in wind and now solar that are more regional, right? It could be the German solar or German wind, where people do want to trade that and they're happy to take any sort of basis risk. This is all pretty correlated well and set up. The indices are tight and well designed. So I think we're really missing broad participation by exchanges who bring different types of products and different types of clearing solutions to create liquidity for players that don't only want to warehouse risk, but manage around it. And for buyers that are like, well, hey, you know what? I like this. I have a trade on, or I'm looking at buying an asset and I'm going to buy this hedge. But if the trade unwinds or it either stops out or it hits its profit targets, or I don't get that asset that I think I'm buying, I can get out of my hedge. And there's somebody there willingly who's not going to sort of be sitting at terrible execution levels, mafia execution levels, and basically take me out of my trade at some level that's actually really reasonably doable. And I'll come back and continue to do that. That gives me confidence to come in and try to buy and sell and trade and do the other things I do operationally in my market, because I know I have liquidity in my hedge products. And the best place to get that, in my view, really stable and reliable way, is through an exchange. And, again, the limitations right now in our view have been that the exchanges to date have really conceptualized their products as what's listed on the contract specs. And I think that a successful exchange in the future is going to think beyond the contract specs and think more about clearing classes of products in a really sort of low friction way.
Thanks again to Martin Malinow, CEO of Parameter Climate. We hope you enjoyed the episode. We'll be back next week with another episode of Weathering Decarbonization. We hope you'll join us.
This episode is brought to you in part by ABEX Exchange, bringing better price discovery and risk management tools to navigate today's commodities markets through centrally cleared, physically deliverable futures contracts in energy, environmental, battery materials, and precious metals markets. Smarter Markets are here. Contact sales at abax.exchange to get started. That concludes this week's episode of Smarter Markets by ABEX. For episode transcripts and additional episode information, including research, editorial, and video content, please visit smartermarkets.media. Please help more people discover the podcast by leaving a review on Apple Podcast, Spotify, YouTube, or your favorite podcast platform. Smarter Markets is presented for informational and entertainment purposes only. The information presented on Smarter Markets should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Smarter Markets are those of the participants and do not necessarily reflect those of the show's hosts or producer. Smarter Markets, its hosts, guests, employees, and producer, ABEX Technologies, shall not be held liable for losses resulting from investment decisions based on informational viewpoints presented on Smarter Markets. Thank you for listening, and please join us again next week.